It's Monday and a rather quiet day for the markets with no economic data and investors simply waiting for Tuesday when some of the major banks report earnings. Though there are plenty of concerns about sky-high valuations across the market, so is a correction on the horizon? Let's ask Scott Wren, Senior Global Equity Strategist at Wells Fargo Investment Institute. And Scott, the S&P 500 is trading at just under 17 times forward earnings, but some sectors like consumer staples are at multiples of almost 20. So is there something the market is missing here?
Well, I think on a sector like consumer staples, we're underweight consumer staples. I do think the valuations are high there. What we're trying to do is guide our clients, as we have been really for the last few years, toward those sectors that are more sensitive to the ebb and flow of the economy. So really, we like technology, we like the industrials, we like the consumer discretionary sector. But I would agree, staples to me, and based on our work anyway, staples should be an underweight and definitely look a little overvalued.
Even though gas prices still remain very low and there's really no sign of prices reverting back to the levels we saw before last summer.
I think gas prices are going to stay low for a little while. Our oil analysts are looking for crude to be up in the $60 to $70 range by the end of the year. So I think we'll probably see a little bit higher pricing. I think also that what we're going to see is we are going to see some more consumer spending based on these lower oil prices. We haven't seen much of it yet, but I think that we will see it going forward as confidence builds, 401k balances are better, gasoline prices still are reasonable. So I think we're going to see the consumer kick in here a little bit, and at least we'll have a modest push forward in the economy. Maybe we grow 2.8, 3%, something like that GDP-wise.
Yeah, and of course we have retail sales numbers tomorrow, so we'll be watching for that. But let's talk about earnings season. We've got the big banks tomorrow, but forecasts for the first quarter overall look pretty grim. But you say not to worry. Why?
Well, I think really the first thing is that earnings are a lagging indicator, and we know we had multiple effects, whether it's the weather, whether it's the dock strike, whether it's the stronger dollar. All of those are going to be used as kind of crutches or scapegoats, I think, by companies who really have had trouble executing. So we're not going to have a very good first quarter earnings seasons. That's not a surprise to anybody. But what we want to do is look ahead. And when we look ahead, we see things improving. We don't see them improving tremendously. But I think you're going to get out of this quarter anyway. I think the consensus is about for a 5% decline. We're at flat basically. But I think by the end of the year, you're going to see something in that maybe even 6 to 7%, 5 to 7% growth rate in earnings for the full year. So we're definitely more optimistic than consensus. We're not wildly optimistic, but I think you're going to see an improving economy. You're going to continue to see companies execute, and I think the consensus is too low. And by the time this year is over, we'll be in that 5 to 7, 6 to 7% earnings growth range for the full year.
All right, Scott Wren, Senior Global Equity Strategist at Wells Fargo Investment Institute. Thanks for joining us.
Thank you.
I'm Scott Gamm, and you're watching The Street.